In today's video, we're going to be looking about how a whole of life policy solved a £620,000 inheritance tax problem. And this morning we have Dylan Baker joining us from South London. Good morning, Dylan. How are you?
Morning, Dom. Doing well. How are you?
Yes, very well, very well. I'm excited to get into today. So I'm familiar with the case already, but Dylan, if you could briefly explain what a whole of life insurance is and how it differs from, say, a typical term insurance.
Yeah, sure. So whole of life is what it says on the tin. It's a life insurance policy that pays out at any point during the insured individual's lifetime. And the reasons that it's mainly used are for inheritance tax purposes, for estate planning and future and further financial planning. So the way that it came about was I had a couple of clients who had an estate in the region of about £2 million across several different properties. And they approached me looking for a way to mitigate their inheritance tax bill for their two children. So we went through a range of different ideas, different topics, trusts, what can you do, can you set up a company and what the charges are. But it actually worked out that a whole of life policy for these individuals was not only the most cost effective way of mitigating their inheritance tax bill, but it provided that guaranteed payout and straight into trust at the same time, so ticking off all of the boxes.
Nice. So the initial challenge here was inheritance tax planning. And interestingly, was the inquiry from the parents, so to speak, or was the inquiry from the beneficiaries of the estate?
Good question. The actual inquiry came from an accountant. So one of my accountant referral partners recommended the parents to me. Now, the logistical challenge with the parents was first generation immigrants. The English wasn't completely amazing, so they deferred to one of their sons to deal with it for them. Since then, we've built a really good relationship, similar ages and whatnot. But he's been dealing with it on the parents' behalf, but to get himself and his brothers sorted out for further down the line.
Understood. So how did the estate and potential IHT liability shape the advice, and why a whole of life policy was most suitable for them?
Sure. So we explored a number of different trust options. Could we move the properties into a trust? Could we set up a limited company with the children as the directors and just shift the property from A to B? But what became apparent is with the tightening inheritance tax rules, all of the little so-called loopholes aren't available anymore. So the only option there was for these individuals was to provide a guaranteed payout to their sons, which in turn paid the inheritance tax bill, which releases the estate. Because in the UK, you can only have access to the estate itself once you've paid the inheritance tax bill. So it's a little bit backwards. But I mean, we were looking at a liability of in the region of £600,000 to £650,000 in today's money, which means the children would have to have found that to then release the remainder of the estate.
So just a quick breakdown then for anyone watching this who might not be 100% familiar. What was the thought process in recommending the £620,000 worth of cover?
Yeah. So firstly, to stress on that point, this is very much in today's money. It's working off of the assumption that the worst case scenario, the parents passed away tomorrow. Now, based on averages, they're not due to go for another 20 years. But in today's money, they had an estate in the region of £2 to £2.5 million. They had their nil rate bands of £325,000 each, plus an extra £175,000 for property. So they have £1 million between the two of them. But it's working out what happens over the next 20 years. As for an example, they don't acquire any more properties, but property values go up. So what we've done is we put a policy in place at the moment that covers the inheritance tax liability as it is. But the beauty of a whole of life policy is you can review it at any point and you can move the cover up or down dependent on the circumstances.
Okay, so how did you ensure the policy would still be effective in 10, 20, 30 years' time?
Yeah, so one of the research points, part of being independent, is looking at which insurers not only have an excellent claims history, have an excellent payout record, excellent coverage, but also what's the security of those insurers. If the clients don't pass away for 15 years, is the insurer still going to be around, or have they been paying premiums for absolutely no reason? So part of factoring it in is picking an insurer that's not only in insurance, but has a number of other different arms. So should one fall the business is safe.
Yeah, understood. And also, Dylan, can you explain what makes the second death whole of life insurance policy with the trust combo, so to speak, so powerful in estate planning?
Sure. So just to answer that, it might be worth going a step back. With whole of life, you can either have it paid on a first death basis or a second death basis. And what that means is if it's paid on the first death, you have a joint whole of life policy. And we'll use the clients as an example here. So Mr. and Mrs. joint life policy. On first death, it would pay out to the other policyholder, which defeats the object of inheritance tax planning, because naturally that money would then just go straight into the other person's estate before it's passed down. So what we've done here is we've set up a whole of life policy on a second death, which means the second event, i.e. the second one of the two passing away, that money then releases into trust with the children as beneficiaries of that trust, so it's protected from inheritance tax. That then releases the inheritance tax money for the inheritance tax bill, and then releases the estate to the individuals when they want to receive it rather than when they have to.
Yeah, so in layman terms, for anybody watching, the whole of life policy, in effect here, to be clear, is the same amount of what would be due in order for the inheritance tax. So it's covering the inheritance tax bill as opposed to removing an IHT liability. And Dylan, what would you say in terms of whole of life policies being written into trust? Would you say this is best practice? Are there any examples that you think it might not be beneficial for somebody to write the policy into trust?
There's never an example not to write a policy into trust. There's always the which trust are you going to use? What are you going to use? How are you going to set it up? Because trusts on their own are a complete different subject, different topic. But I mean, you've got different rules you need to take into account. So what's called a PET, a PET, or a CLT, a chargeable lifetime transfer. So you've got to work out, do you want to set the trust up with the beneficiaries set in stone, or do you want to set a trust up where the beneficiaries are open to changing circumstances over the years? Now, in this case, I know for a fact and made a judgment call that both the parents and both the children are an extremely tight-knit family and also an extremely small and secure family. So we've set this up on what's called an absolute basis, which means that the beneficiaries are set in stone. It's the two children. It's unlikely to change. Yeah, that means that a 7-year rule then comes into effect, which tears down on a tapered structure for inheritance tax purposes.
So obviously we've spoken quite a lot about the end game here, and obviously the goal of this whole of life plan that's been set up for your client is to cover off the inheritance tax. Could you also explain to our viewers how the mechanics work at the beginning? So if you could just talk us through what was the first step you had to do with the client in terms of getting the quote? Once the quote came through and the client wanted to move ahead, how does it actually work on going on quote and then actually the policy becoming in force? If you could just talk us through the rough timeline and mechanics there.
Yeah, sure. So my first conversation with these clients was, I think, way back in July, August last year, when they were really just trying to ascertain what they can do and what they can't do and what the options are to them. So we went through a lot of different options. What are we discounting before we recommend anything? Because there's so many avenues that you can go down here that are client specific. So what did we look at? So we looked at moving everything into a limited company. That wasn't an option because in the eyes of the taxman, that means you'd effectively be selling the property and a chargeable gain would then come up, which is beyond what the insurance premiums were. We also looked at other trust arrangements where you just move it straight into a trust, but that would incur a straight up 20% tax charge straight off the bat, which actually worked out to be more than the insurance premiums for whole of life over a 20-year period. So it was all about proving to the clients or showing the clients that all of the options had been discounted before we got to what it is that we're doing, because it's not an insignificant amount of money that they're paying every month. Whole of life isn't cheap because an insurer has to cover the risk of a guaranteed payout further down the line. So that's really what we were looking at, and we were discounting, but it worked out to be the most cost-effective method as well as the most effective method, full stop.
And also for the client in general, once the client has kind of given you the green light and said, yes, I want to go ahead, how does it work with the insurer from sort of their side of wanting to do their due diligence of like, okay, is the client who they say they are, and their health condition, and once they've been through like those health steps, how does it then work? Like, how many days or weeks does it take for the insurance policy to, in effect, go live if something were to happen to them?
Sure. So when you're talking about coverage levels of this size and monthly premiums of this size, naturally the insurers want to do their due diligence and their underwriting before they'll insure the couple. So one of the part of what I do, part of what the company does, is the due diligence before you recommend an insurer is making sure the insurer can insure the individuals that we're talking about, and if they can, what hoops and hurdles are the clients going to have to go through to get to that point. Now, there's a thing called medical limits in insurance that if you have over certain levels of cover, you need to go through different medical tests, different exams, doctor's exams, cotinine tests, nurse screenings, just to name a couple. So it's very much a case of understanding what insurer requires what, managing the client's expectations. They're going to need to have a doctor's home visit. They're going to need to clear various different medicals, and just making sure that they're set up, ready for that to take place. Now, that sailed through, and thankfully the clients were in good health for their ages. I think the policy from that point probably took about 3-4 weeks to come to fruition via a report from the GP.
Understood. And I think you've mentioned to me before, Dylan, about that depending upon the, there's a way in which clients almost get a month's worth of free coverage from the date of the premium and something like that. Can you explain that quickly for our viewers?
Yeah, sure. So if you work it smartly and you want to have the difference between a start date and a premium leaving a client's bank account are two completely different things. So a start date is when the insurance goes live. The premium date is when the client pays for it. So if you set up a policy for a client to pay on the 20th or to start on the 1st and the client to pay on the 2nd, they'll pay for that month the day after. But if you set the policy up to go live on the 1st of the month and the client not to pay until the 30th of the month, the vast majority of insurers will provide that month for free to the client, which is another sort of selling point for that client and nice for them as well. Understood.
So Dylan, what would be your advice to any clients, advisors, or I know this client came to you through an accountant, who overlook whole of life policies as sort of a viable IHT planning tool?
Yeah, I'd say have a conversation, Dom, with someone like me, if not me, you know. So the worst case scenario is I can tell you a whole of life policy is not going to be relevant for you and I might be able to point you in the right direction. But the worst case is I say no, you know, but you don't know that until you try. So one of the things we'd do is we'd go through everything very specific to the individual and then really work out if a whole of life policy is actually going to be relevant for them. Then it's their prerogative what you do thereafter.
Yeah, and obviously with the changes, as we all know, coming up with the autumn budget from 2027, UK pension pots will form part of one's estate for IHT planning purposes. So do you see whole of life policies becoming potentially even more popular following 2027? And for some people, often one of their largest assets beyond their home, also with a pension now forming part of their estate, an IHT liability.
I think so, personally, and I think it's a view that's shared across the insurance industry that whole of life policies are already becoming a lot more popular, and that's off the back of the last budget and preempting the next one, or preempting the 2027 changes with pensions. So the direct impact is pensions now falling into the estate means everybody's going to have a bigger estate that has a pension, and that's going to need to be covered at some point if they plan on passing it down to somebody else. Whole of life policies, especially with a reputable insurer, and most of them have over a 99% claims history on payout, is the most cost-effective, the most efficient way of protecting your IHT bill.
Understood. And Dylan, would you say there's any, in your experience of working the whole of life over the years, would you say there's any or many misconceptions by advisors or clients when it comes to whole of life plans?
I think there is on both sides. So, you know, insurance historically, regardless whatever you want to call it, has had a bad rep. And it's had a bad rep because historically insurers haven't wanted to pay out. But the fact that insurance, especially during the retail distribution review, RDR in 2012, the FCA took a much closer look and started to overlook a lot more of the insurance industry, that it now falls in line with the regulations and the expectations of the rest of the FCA, right? I think from an advisor side, just looking at it, I think a lack of knowledge to do with it can impact. I think the amount it can cost per month can put advisors off from talking to their clients about it. I think what it comes down to on both sides is a lack of knowledge that can lead to fear.
Yeah, understood. And like, if there's anybody watching this video today thinking, yes, I'm going to have an inheritance tax bill, I'm not sure how I'm going to be able to solve it, or, inheritance tax is one thing that a whole of life plan is used for. It can obviously just be used to provide money. Even if you have no IHT bill, it's a great way of ensuring, your loved ones are looked after, particularly if you have, say, large outgoings as a family or whatnot. So what would be your advice, Dylan, to somebody who's unsure about a whole of life or what may or may not be suitable to them? What do you think would be the best steps for them?
I think if you're unsure about what you're doing, it's always good to talk to someone, and that brings it back to the worst case is somebody that knows a little bit more than yourselves can tell you that it's not a good idea, and that gives you the peace of mind to explore other avenues or to not explore anything at all at this point. But what it comes down to is peace of mind. It's being told by a professional, or having your own points reaffirmed to you, and then working it out from there.
Yeah, absolutely. I mean, from our side here at Cameron James, our protection insurance is the same as our pension transfer work. Get out, get in touch, talk to one of our financial advisors. You can talk to Dylan, have a conversation and understand what your needs are, how we can help you meet them. We put together the report which outlines the protection insurance, and it's a yes-no decision from the client's perspective. There's no, you're not signing up by having a conversation with us or getting a report through. It really is to put you in an educated and informed decision to decide what to do, what you think is best for your family's future. And as in this example here with Dylan, it was very much a family decision. He was working with the children. Obviously, the policyholders are the parents, but really working together to try to work out how, as a family, they look to maintain that wealth that the parents have amassed together for them. So Dylan, thank you very much for joining me this morning from London. I'll let you get back on with your day. But yeah, thank you. Thank you very much.
Yeah, thanks, Dom.
And as always, wherever you are, take care of the UK pension assets.